Morning, and we're doing chapter 13 and later 15. So 13, you're gonna have a project as well. So this would help you with the project. I just want to make sure that you're reading on chapter 13, sales tax and how to create inventory. So when you're doing a new company, based on chapter 13, the setup has to be with the interview, not the express start, because you're doing inventory. So setup has to follow the interview and not express start. You're going to say that you're doing a retail company with inventory. Okay, second step, you're customizing chart of accounts. Then you create lists, you create sales tax items, you entering opening adjustments. So I want to discuss enter opening adjustments. I'm going to show you what happens and how to fix this. So opening adjustment happens because you have beginning balance on account receivable. Let's say a customer owes you $400. So it creates a $400 opening adjustment of income that's not categorized. And the same thing happens if there's an accounts payable. If there's an accounts payable opening balance, you're going to start with this vendor owes me, we owe $2,000 to. So it creates an uncategorized expense. So you have to understand where things coming from and why do you need adjustment. So when you're coming from manual to computerized, you usually have opening balance of account receivable and opening balance of accounts payable. And that's going to create an adjustment that's going to be needed because it's not income this year, it's from previous year. So you have to fix the adjustments in the beginning. All the adjustments are doing, we fix it into opening balance equity. Opening balance equity disappears after the setup is done and your balance sheet will be perfect. So record transaction, prepare trial balance, enter adjusting entries and adjust the trial balance and prepare reports. So all this is a review that I gave you in project 13 that I wanted to see. On chapter 13, you also have a quiz and that's it. And you're submitting financial statements. So complete the easy step interview. You have to do easy step interview, not express start. Add people you do business with. It means vendors and customers. And you're going to make sure if there is beginning balance to do it carefully. Add the products and services you sell, and then you add a bank account. So you start with chart of accounts and you got customize your chart of accounts. Then the rest of the list will be inventory that you sell. Okay, so here's again, the same steps. Answer remaining questions. So since you're doing usually retail, you will have to say yes to sales tax. So definitely retail shop charges sales tax. Okay, compared to service that most of them don't. Do you want to track inventory? Always by default, track inventory is on a no. I'm pointing out that this must be switched to a yes. Okay, otherwise you'll have to do this interview again. So track inventory, you have to say yes. Okay, so list, here's the reviewing chart of accounts, that's chapter 2. To add account, edit account, delete account, they just want you to review. Again, I don't care about tax line mapping. You're not graded on that, so don't worry about tax line mapping, leave it empty, unassigned. Use list of customers to track them and vendors. So that's accounts receivable. This is accounts payable. And of course, inventory. Employee list you're not going to use in project 13 because you work for yourself. So you will not have any employees. Okay, so after you add a customer, you could add a job. That's a secondary. And vendor list doesn't have a job. You just right away the vendors is in the margins. Okay, when you come to items, you have choices between service, inventory, non-inventory, and sales tax item. So I'll give you an example of sales tax and I'll show you how I'm doing it. Now here's the important part about chapter 13. Account receivable opening balance are offset to uncategorized income account, which means when you're just saying, Mr. John Doe owes me $200, you are creating a $200 entry, debit to account receivable, but the credit is to uncategorized income account. So you will have to offset that because it's last year and he says, okay, so you made money, but it's not money that we earned this year. It's from opening balance of last year. So it really doesn't belong there. It really belongs in retained earning. So that's the reason you need to offset. You will have number 3 to do. So first, to understand where it's coming from. Account receivable, debit, credit, uncategorized income. Second one, if you're putting a vendor, accounts payable is going to be credit, but the debit is to uncategorized expense account. Okay, so I'll show you that and how I fix this. Opening balance of inventory sometimes have to be offset also to opening balance equity. So if you had inventory from last year, it's increasing an entry and opening balance equity. So if you write down, I have $10,000 of inventory from last year, the debit is inventory, the credit was opening balance equity. So you have to offset and make sure that opening balance equity is fixed at the end. What does it mean? So here's your 3 items: accounts receivable, accounts payable, and inventory. And other balances might also create opening balance equity. And all of it you check and fix, and then you move it to capital stock. So opening balance equity will become 0 and capital stock will have the balance. So it's really 1, 2, 3, 4 entries most of the time. 4 journal entries to fix the beginning balance. Okay, so this slide summarized the steps. First, you transfer uncategorized income to opening balance equity. What does it mean? Because income is usually credit, we're doing a debit. So debit, uncategorized income, and credit opening balance equity. Second one says transfer uncategorized expense. Expense is always debit, so we're going to do that as a credit. Debit opening balance equity, credit uncategorized expense. You'll have to know the amount. Transfer opening balance equity to capital stock. So opening balance equity will go to capital stock account. Record transaction for merchandising, owner's investment, vendor expense, and customers and sales transaction. Okay, so I'm going to do an example of a new company just to show you this. Enter inventory items, order and purchase. After purchase, you know that you're going to have received items, so receive inventory, most of the time without the bill, because the bill comes later. Record bill received using enter bills against the inventory, so you have the 3rd step. And the 4th step is pay bill. Now, if you missed any step, you will not see your bill ready to be paid, so it's not going to come here. And that's the good control that they have into the system. If you enter the inventory item, but you didn't receive it, but you got a bill, if you didn't receive it, you're not going to be able to pay it. So it has to be received bill and received inventory, that you received both. Customers and sales transactions. You could create an estimate or sales order, but that's a waste of time because those are not posting. So always remember, if somebody's selling on accounts, whenever I would say sell on account, you have to create an invoice. Create an invoice to record the customer charges using create an invoice window. Okay, so waste of time would be to create an estimate unless you're planning to take the estimate and convert it into an invoice. But most of the time you don't. So don't do sales order and don't use estimates unless they tell you. Sometimes you'll take an estimate and convert it into an invoice. Number 2, record customer payment using receive payment. So we receive payment. We don't go directly to record deposit, because if you go to deposit and you just say account receivable, John Doe giving me money, it's not applying it to any invoice, and it's always wrong. So you never ever make a deposit from account receivable. It's always going to be from undeposited funds because it has the 2nd step. 2nd step is record customer payment using receive payment window, and then record deposits using the make deposit window. Okay, I'll review with you now. And of course, try balance is to verify that everything is right. And then you create adjusting entries. So this was a good project because it's really reviewing the whole accounting system. Adjusted try balance, after adjustments, and then financial statements. So financial statements are, of course, profit and loss, balance sheet, and statement of cash flow. You'll be doing 1 month, so you're doing all of them for that specific month. If you're doing the work of January, so it's January 1st to January 31st. If you're doing March, it's the whole March. And balance sheet is always one point in time. So if it's January, it will be January 31. Statement of cash flow, it's for the period. So it's again, from the beginning to the end. If it's 1 month, January 1st to January 31st. So remember that the schedule should be profit and loss for the month, statement of cash flow for the month, balance sheet is one point in time, one date. Okay, so let's share now QuickBooks and I'll show you what I mean. Okay, so on QuickBooks, what we just discussed, purchase order, receive inventory, enter bills against inventory, and pay bills. You're doing all that when it comes to inventory. If it's a regular bill like utility bills, you're going to be doing it here. Enter bill, pay bill. Or if you're buying a computer without a purchase order, without any of this. So buying equipment, it's going to be debit equipment, credit accounts payable, and then pay bill. You're going to pay it. Manage sales tax over here means we're going to pay sales tax payable and we issue a check. Okay, so sales order and estimates, I said it's a waste of time. Those two you don't have to do, but you definitely need to create an invoice on project 13. All of them are invoiced. All the customers are buying on credit. Then receive payment. Okay, you're switching to receive payments. A couple of days later, we got a check and we're applying it to that invoice. And then you record deposit. So if you have something in there that you need to cancel, you just press cancel. You know, those payments, you don't need to do them. But you're definitely going to, if you do from payment, you select and you're making a deposit, it's always going to say undeposited funds, and that's correct because it came from step number 2. Okay, let's go on. Okay, inventory and services, I'm showing you here. I click on items and services. I'll maximize it so you can read. You have a lot of categories, inventory, parts, service, and so on. Okay, so service means you're basically doing a service and you're making all the money yourself. So here's an example of a service. If I'm doing framing, framing labor is $55 an hour and it's non-taxable. See, it's non-taxable. And it goes to labor income. Labor income. So that's how item service looks. If you're doing inventory part, let's switch to inventory. Edit. Cabinet pulls means handles. So cabinet pulls, and you have each sold each 2 case, and it's $3 cost. Sales price could be $10 or whatever we want. So right now it's 0, but you will fix it on the invoice. Of course, this is a tangible goods, and that's why it's taxable. Definitely taxable. Every item we sell that is not a service is taxable. So over here would be materials income. Okay, what I want you to notice is, first of all, you saw the service a minute ago. The screen is much longer and you have more, in really a lot of entries. Cost of goods sold is here. Material income is here. And inventory asset as well. So what's happening is when we do a sale, it's going to be like this. $10 account receivable or cash. But this account, material income, gets a credit. Then there'll be a second entry, which is the cost of goods sold, which is right here, $3. And inventory going down, inventory asset. And that's the reason you need all these 3 accounts. The answer is not really $3 because we're working by average. Using QuickBooks, you're using average. So if you're looking at the screen carefully, average cost is right here. So if I said that I'm selling for $10, you will see $10 minus 2.55933. You will see this. Okay. And this price will be the difference. The difference will be in profit. Okay, so I'll do an example of that. I'm making this time a cash sale. Cash sales is not a create an invoice. It's right here. Create sales receipt. Okay, so I'm choosing a customer. And I'll say that he's paid in cash. I'm choosing cabinet pulls, those handles. And I'm charging $10. Now I'm doing it just to show you how I'm checking the system to make sure that QuickBooks works well. I'm doing it on one date, December 30th, 2022. So what I see on the screen is one debit, $10, Okay, that goes to cash, but it's really not the total. It's 1078 goes to cash because we're charging 0.78 sales tax. So over here we have a credit, sales tax payable. I know you don't see all of it on the screen, but there are 3 lines really on this entry. $10 is the material income. 0.78 is sales tax. So 2 credits to 1 debit. The cash is 1078. I'll show it to you in the journal. So I go back 1 and I'm going to go to reports just to show you the journal transaction. Transaction journal shows this 1078, $10. I'll make it smaller here. So you could read it, and I totally don't need class. We don't need class at all. Okay, so let's make sure you could read it. Okay, so undeposited funds, which is the cash, is 1078. It went temporarily at the undeposited fund until we put the deposit in the bank, which means the cash is on your desk. Material income is $10. We see a credit of $10. Inventory asset, 256. Cost of goods sold, 256. So we have the difference right here. Now I'm going to show it to you. And here's the 78 cents that I talked about, the sales tax payable. So really when you do journal entry manually, you would do 1078, $10 and 0.78. That's the first entry. Second entry is cost of goods sold debit and credit material income, which is it. In here it's inventory. Inventory 256 and materials income right here. So you have over your cost of goods sold and inventory asset. So usually debit first, credit next, but it doesn't matter. Let's look at report. So I did it on December 30th to show it to you. I'm looking at a profit and loss for 1 day. Okay, so I'm working on changing the dates only for 1 day, December 30th to December 30th. I want to check if it's working well. Yes, it does. Okay, $10 is material income. Minus 256 cost of goods sold. That's correct. I got gross profit of 744. Okay, so it's definitely working and it's doing the inventory correctly. So that's the reason you need 3 accounts. You need materials income, you need cost of goods sold, you need inventory. The debit could be an option. It could be going to account receivable if you made an invoice, but it could go to undeposited when you made a journal entry like this one. When I went here to sales cash receipt, you went over here. And that's the reason I have over here the 1078 from Natielo Ernesto. Okay, so here's my Natielo Ernesto, and I can put the money on the 30th if I only got 1078. Okay, so I finished that one. Okay, so this is about to show you the accounts receivable and accounts payable. Now I want to talk about beginning balance. The chart of accounts right here says account receivable is 104,000. Okay, it's harder to show it in a existing company. Let me see if I can do it in a new company. Okay, so I'm not using Express Start. I'm going to do Detail Start and show you how to set up a company. Doing chapter 13 completely. I just want to show you the beginning. So Dragon Enterprise is selling. Okay, all the rest is, by the way, not so important. It's a retail store. So it's retail, shop, online commerce. And I want to do accounts receivable and accounts payable. So we're saying that it's set up as an S corporation. What you're setting up is really from the book. It's project 13, saying 1120S S corporation. So I want to discuss the beginning of accounts receivable and accounts payable. I'm not following the book right now. I just want to show you how it's done and how to correct things. So I'm going to save it. So I went through the interview and saved it as retail and as corporation. That's all I did so far. Okay, so here's my questions now to customize it. Because it's retail, I'll say yes to selling products only. I'm not doing service. You're selling like telephone cases, so you're not giving a service. But if you're not sure, it's not terrible to do both service and product. But since the book told me product only, I'm doing product only. Record each sale individually. The other two says summary, like if you will have a cash register and somebody will type all the totals of the week. And use QuickBooks point of sales means right away, every entry is on QuickBooks. Point of sale is each cashier basically doing, it's computerized and goes to QuickBooks into it directly. So we're gonna record each sale individually. And yes, because we're retail, you see it's recommended, sales tax, and we say yes. Do you wanna create estimates? The answer is no. Maybe it will say yes, but I doubt it because only in service we create estimates. Tracking orders, yes. Using statements in QuickBooks is a yes. It's reminders to people to pay. So it's not terrible to say yes, but the idea of billing statement is more for like a gym that does monthly billing, things like that. So recommended usually no. I went too fast, but I'm telling you that recommended for progress invoicing is no. It's only when you're doing a lot of major milestones. So this is not. Managing bills you owe, it's definitely yes. We want accounts payable. We want to know which vendors owe us money, how much money we owe, and reminders. So definitely we're going with yes. I want to keep accounts payable. So project 13, I'm testing you on accounts receivable, on accounts payable. So definitely yes. Here's always by default a no. That's what I was pointing out in the slides before, that you make sure to switch to a yes. So switch to a yes. If you made a mistake here, there's a way to fix it. You will have to go from edit preferences all the way down to inventory and fix it and say yes, track inventory. So there is a way to fix it if you continued and you said no. Okay, tracking time is not important. Do you have employees? We said no. So we're ready to start. Select the start date of your business. So if I would say beginning is 1/1/2020, it means I will take, and we were in business before. I don't want to start entering 2015 until 2020. I want to bring the information from December 31, 2019. So the last balance sheet is all I need. Very important point that students of accounting should understand. I only need a balance sheet. I don't care about profit and loss. You could look at a profit and loss, but you don't need it because it's already in the balance sheet. It's in the return earning after the close. So really the important paperwork is a balance sheet only. Profit and loss, the only reason you would look at it is to be familiar with the company. That's the only thing that I would do. I want to be familiar with the type of accounts, with the type of expenses, and how they generate income. Yes, you could look at an income statement, but it's not a must. So if you want to start a new company, you always need a balance sheet of the previous year, and you don't need to enter everything else. Okay, then you go next, and next again, because recommended is usually good. So if the company has service sales as well, you're going to enter extra, but you don't really need to do any of this. See, all the accounts are there. Ask my accountant is very good, so I definitely keep it there. So ask my accountant is whenever they don't know what to use, they would use ask my accountant, and eventually the accountant will fix the account. So that's discussed later in chapter 15. Okay, so we finished the setup because I did the interview. Now, the reason I'm doing all this is just to show you how to get rid of beginning balances from the beginning. When I say add people you do business with, and I'm not importing from anywhere, but unless you do, if you have a lot of customers and you're going to bring it from Excel, good idea, you should. I'm going to do 2 customers and 2 vendors, just to give you an idea. So let me just take something from the book, so it's not going to be from my head. I think Sophia. Okay. So here's an example of a customer. I'll do it all caps so you can see better. Sophia Raphael. I go to first name Sophia, last name Raphael. Or if you want to do Raphael, Sophia is also fine. And the rest of the information is not necessary. It's enough like that. Let's take another one. Okay, they didn't give me another example. Okay, so I'll take one from your project, a real one. Petite Mimi. Petite Mimi. Okay, so again, Mimi Petite. This is not a company name, it's private. Okay, then you go to vendors. I'll do two. Brewer Paint Supplies. I guess I'll take, no. Telephone supply. This time it's a company. Second one will be Jackson Computer. Okay, this is not really the same one as you see in the book, but I just want to get the idea of it. So I have four. Okay, now listen to what I said about doing it carefully. When you're going to press continue, you'll be asked about beginning balances right here. Enter opening balances. So don't skip it, but if you did, you will have to redo this customer and each one go and type it again. So you go into one, let's say Rafael Sophia owes us $300. And we owe, an example, $500 to Brewer Telephone Supplies. I can even do 5,000, it doesn't matter. That's my beginning balances. So customers are account receivable and vendors are accounts payable. Okay, it is important to do the dates correctly because it's a journal entry. So make sure you're doing the correct journal entry and saying this came up on December 31st from last year, 2019. Last year. Again, I don't care about the second one because it's zero anyway. That's not a journal entry. So I'm doing December 31st, 2019. Okay, so December 31st, 2019 was opening balance that I saw on the balance sheet. That account receivable is 300 and it's generated by Sophia, she owes. And the same thing, 500 by accounts payable. But I'm telling the computer who it is. So what happens on this screen, you don't see it, but it's debit over here to account receivable and credits to uncategorized income. This side, it's debit to uncategorized expense and credit to accounts payable. So I'll show you the problem created already. Add bank account, let's start with bank account. I'll say checking and maybe I have nothing. Opening balance, I'll do zero. Doesn't matter, just continue. Okay, so I have an account. No, thanks. I just want to start working. Oh, I forgot to show you beginning balance of inventory. Okay, so we'll do one inventory. Okay, one inventory items right here, items in inventory. This what came from the program, consignment goods. Consignment means that you're holding goods for somebody else. So let's say I have 5 iPads that are not mine, but I'm selling it for somebody else. Second one, non-inventory items. It's something I don't really carry, but when somebody wants it, I order it for them and they sell it for them. So it's like a middleman. The last three are really about taxes: local tax, out of state, and state tax. So if you want to do state tax, and the book will tell you a ratio, you just have to double click on sales tax, and you right away in the edit mode, you will have to do the rate, let's say 7.65%. Just giving an example, and which agency it's paid for. State Board of Equalization. Okay, given by the book. So if it's quick add, is because you're adding a vendor. See, this area says vendor. So now we just added a new vendor called State Board of Equalization. If it was New York, I could have wrote New York Department of Finance, New York City Department of Finance. So the vendor is who's going to get the check that belongs to the sales tax. So say, okay. And we just created one. Out of state, you see it says exempt from sales tax. It should stay 0 because they're exempt. So if you're selling from New York to New Jersey, it's exempt from sales tax. You will have 0 tax. Okay, so nothing here says about inventory. So I have to add item, new. And we're not doing service, we're doing inventory part, the second one. Now, if you already have a problem and you don't have inventory part, it means you said no to track inventory. And this is the way you fix it. Edit, preferences, go to items and inventory. Okay, over here on the side on the left. And after you pulled items and inventory, go to company preference. And this is off, the check mark is off, put the check mark on. It will close your windows, open your windows. So this definitely is the problem, that you said no to inventory. So fix it, and then you'll go back. Then you can come back here and say item new, and you'll be able to find inventory part. Okay, so inventory part would be, let me take an example from chapter 13. Dragon Enterprise. They sell, okay, let's take portable speakers. Okay, so I'm writing portable speakers. Oh, without sub item. And we go over here, portable speakers. Okay, so this usually copied from this side to the other. And the price would be portable speakers, cost $30, and we sell it for $120. Yeah, that's important. So we know the cost. Cost, you always have to be very careful. If you forgot sales price, of course, you'll type it on the invoice. But if you forgot cost, you'll have to redo this. So be very careful. Preferred vendor is where we're buying it from. Let's say Brewer in this example. Now, income account is which account going to be associated with income when we sell it. So the answer is merchandise sales. Oh, I don't have account numbers yet. Okay, so choose merchandise sales. Okay, I didn't choose account numbers yet. But what I wanted to tell you about it is really on the bottom. Inventory asset right here, if you have 10 pieces in stock, or if you have 100 pieces in stock from last year, you're going to put it right here. Okay, 100, and the computer will do 100 times 30, and it's going to be 3,000 here. Or if I would say I have 10, make it 40. I have 40 items. I have 1,200 in stock. So this is a journal entry, and I'm very careful with the entry again. And I say 12, 31, 20, 19. Okay, last year. So I just created the debit to inventory asset of 1,200, and the credit is to opening balance equity. So I say, okay. And yes. You sure it's 90 days in the past? Yes. Yes, all these warnings are usually very good. Remember, they're here. Edit preferences, accounting, and you're supposed to say edit preferences, accounting, use account numbers. And if you don't like the warnings, take them off. But I do prefer to have the warnings. Okay? So if you don't like to say warning, it's in the past, take it off. Any questions so far? The setup caused, I want to show you what it caused. Look how funny it looks. There is a profit and loss of uncategorized income, uncategorized expense. Where this 300 and 500 came from? So the answer is okay. So I'm discussing project 13 just to help everybody with the understanding why you need the adjustments in the beginning. So you see uncategorized income and uncategorized expense. That says 2019. If I would say 2020, 0101 2020, I would not get anything. Okay, let's do it again until January 31st, 2020. I'm not getting anything in profit and loss because this was done on December 31, 2019. But my problem is really on the balance sheet. Okay, let's look at the balance sheet. Now, it doesn't really matter the date, but let's say I want to understand December 31, 2019. What does it show? So it shows 300 accounts receivable, 1,200 inventory, what I just did, 500 accounts payable, and opening balance shows 1,200, which is the 1,200 of inventory, minus 200 net income. So this minus 200 is like retained earning. If I change the date, you will see, let's switch it to next year. You see it became retained earning minus 200. So it's retained earning minus 200. We should not have any retained earning in the beginning of the year. So they're saying you have to adjust everything to opening balance equity. Okay, all of it will be adjusted to opening balance equity. So after you type the beginning balances of checking and everything that you need, okay, they're discussing how to remove this and this. So how do we do it? We're going to company, make general journal entries. Okay, I'm reminding you it was $300 accounts receivable. So let me deal with accounts receivable first. Okay, I'm doing it on December 31, 2019, same date. Accounts receivable is correct. Uncategorized income is incorrect. I don't want to have $300 there. So I do uncategorized income, 300 debit. This is exactly in the book, but I'm explaining it to you why you need to do it. Then opening balance equity is going to be a credit. This is to offset opening balance of accounts receivable. I don't want to create return earning. I want to make it disappear. So that's my first entry. I offsetted no income, no return earning. And again, why did it happen that it was only 200? Because one of them showed income of 300, the expense was 500. So the offset of a loss of 200. That's the reason it was 200. Okay, then I do the second one. So uncategorized income disappearing now, it's going to be 0. And opening balance equity gets a credit of 300. Next one is the 500. Now the 500 was uncategorized expense, and I want the expense to offset the expense. And that's to offset opening balance of accounts payable. Okay, so uncategorized expense will get the credit. Debit is opening balance equity. Again, I'm just zeroing it out. What we're doing is exactly like a closing entry. Uncategorized expense gets closed, opening balance equity, we use that account. Last one. the last one doesn't need to be done yet because I'll show you that I refresh the account and you'll see that you have 300, 1200, 500, and now this is opening balance equity is 1,000. The opening balance equity grows as you're typing your chart of accounts as well. So example, let's see what they have. Beginning balance for chart of accounts. Okay, they really didn't do it. Just checking. Okay, so out of state is the correct one. Okay, let's see. I think the book didn't give beginning balance on checking. Okay, he did. Checking is 10,000. So I'll do the examples from the book. If I would say accounts payable, chart of accounts checking, I'm going to edit. Checking account is 10,000. So I go over here, enter opening balance, 10,000. And they're giving you a date. You do it as 01/01/2020. Or, I prefer this date always if you were in business before. So 12/31/2019. So that's the better date, and the date and checking account is 10,100. So we have an account number as well. Okay, so that's your regular checking where you're going to write all the checks. Okay. So 10,000 is done, account receivable is done, inventory is done. As I put the 10,000, you see that you have opening balance is 11,000. So your entry would be, when you're done, to move opening balance equity to capital stock. Okay, so you have two choices of doing it. If you want to make it simple, you just go to capital stock when you're done, and you know it's 11,000. You just do edit, and opening balance is 11,000. The computer would move it from opening balance equity directly to this account, and it's going to be 11,000 in capital stock. That's one easy way. Okay, you see it became zero. Opening balance equity is zero. Second way, which the book prefers to do it, you could go in company or account, it doesn't matter. Make general journal entry. So it's like your next adjustment. And you're moving 11,000. Don't do it again. I mean, by me, it will be duplicating it. So it's opening balance equity gets a debit and capital stock gets a credit. This is to close opening balance. Okay, so that's your third adjustment. Now, this is not going to be the amount. I'm telling you right now. In your project, it's not going to be the amount. The amount will be different. So you have this instruction, and please don't miss it. Move whatever the balance is and transfer it to capital stock. So I'm reading page 7. It depends on your book, 733 or 731. Opening balance is step number 6. Okay, so this is all that I discussed about beginning balance. All the rest you should be, clear to you. Okay, so now we're going to go switch to chapter 15. Good luck with chapter 13 and the budget, but we're going to continue now with chapter 15. So I'm going to restore the other company. Let's just do file close. I don't need to memorize. Everything's correct. And I'm going to open sample product. No password yet. Okay, if it happened to you, you have I need to do it. Let me just copy this. Okay, I have 30 days to do it, so I hope I'll do it later. Let's see if it works. Okay, great. Okay, so now I'm back in Rock Castle Construction, and what I want to teach you is future budget. So first, well, let's look at the company and to understand something about the company. What I want to work on is two types of budget. There's profit and loss. There is a budget for balance sheet as well. Okay, so if I say the whole year, show me this fiscal year. This is January till December 2022, the whole year, 01 to 12/31. So what I see over here that they have income of 114,000. Okay, the reason they have so much is they didn't do all adjusting entries. Let me see if they did depreciation here. No, there's no depreciation. Okay, so I can customize the report and look at comparison of 2 years, previous year, change and change. So I'm getting 4 columns. I just want to see how much was depreciation last year. Okay, depreciation last year was 44,435. I'm going to make it a little bit long, a little bit higher. So make journal entries. End of the year, so it's December 31st. Okay, so I'm making depreciation expense 45,000. Just rounded number, that's the reason I did it. And the cumulative depreciation 45,000. This is annual depreciation. And see spreadsheet. Of course, they don't work like that. You would have a spreadsheet of information why I did 45,000. Okay, so save and close. Now it will give me a better understanding of this year. Okay, so I have some more expenses that are still not done, but it's better. So last year was 25,000. This year we're closing to close to 70. Okay. The reason I did it is I want to prepare a balance for next year, for 2023. A budget, I'm saying, not a balance, a budget for 2023. So I need to prepare my next year. So we are in December of this year, but we want a budget next year. So where do we go? Okay, you're going to go in menu again. It's not, you will not find an icon for this. So it's menu, company, planning and budgeting, and set up budget. So what I'm starting right now is chapter 15. Set up budgets. And there is a budget that's already being prepared between 2023 to 2020, 22, 23. Okay, so we're going to create a new budget. Now the limit on this window, you are putting all the expenses here, but your problem is that you will not see on this screen, is there a profit or loss? You don't see on the screen at all. You will have to go to reports to see if there is an income or expense. So you're working kind of blindly because there's no bottom line here. And as you're saving, you can continue. Okay, so how do we start? So this is somebody already prepared. So I don't want to work on this one. I want to prepare a new one. So create a new budget for just the year 2023. And you see the two choices, profit and loss or balance sheet. So profit and loss is, of course, prepares activities of going to be income and expenses. Balance sheet is going to be the assets, liability, and equity. So we're going to start with profit and loss. Next. Only the year of 2023. Okay, so then the next one says Do you want no additional criteria? Or do you want it by customer, job, or class? Now, it's very important when you do non-for-profit that you must use class, because class means what is the group of income, like a fund income on a non-for-profit. So if you're non-for-profit, you would create a class. What does it mean? Again, if you have like, let's say JCC or Y or whatever, one is a class, a school education program, and the other one is gym, or the other one is a pool. So then you'll be using classes. But for us, we're going to, it's one company, RC Construction, only construction. We don't need specific budget to a customer, so we're going to go next. I want the annual budget prepared for next year. Of course, it's only planning. It's like I have a crystal ball and I hope it will be like that, and things can change. So you could create a budget from scratch, but that takes a little bit longer. It's easier to create budget from previous year actual. And that's the reason I made even the journal entry for depreciation. Okay, so anybody who wants to see me for office hours at 2 o'clock is still okay, yes. Today. So 2 o'clock today is fine. And I start at 1 o'clock. Okay, so create a budget from previous year actual. That's the best way. And you say finished. So that brings us all the information that we used. Now, quiz for chapter 11 should be done by everybody. All the quizzes for every chapter should be done. Okay, so what you're seeing here is an example of 2023, a forecast of 2023 future income. Okay, now I'm going to show you how I change the numbers. If it's the same, it's going to be copied across. Okay, so look at the bottom of the screen carefully. They have very nice features here. You have copy across, you have adjust row amount, and clear. So sometimes you want to clear this completely. You want to clear the page? No. So we say no. And if I want the 0, I would do 0 and copy across. See the word copy across? So everything becomes 0. So what I saw is about 3,000, 3,400. Let's say I'm projecting $400 every month. I copy across. So 4,800 is my design income. Next account is equipment rental income. It means if I bought something expensive and I rent it to other people, let's say I do hope that $100 every month. So I'm going to copy across. As I'm changing, the income's going higher. So subcontractor labor income was this amount. So we're making money on subcontractors. And I'm continuing down the road, see if I have any changes. If I think that we spend more on fuel, I could just fix it. But you see, it's changes a few months. Repair maintenance, they didn't do across the board. There's sometimes yes and sometimes not. It looks like 1, 2. Yeah, they did it by quarter. So you see, it's the first one in a month. January, they paid it. They paid it in April. So they have a quarterly expense. That's what you're learning from this. Okay, disability insurance. This is every month, correct, fine. Okay, let's discuss finance charge. An example of finance charge. Let's say I took a loan and I know it's about $100, but I wanted to compound it. So I go into adjust row amount after I typed it. And currently selected month. And now you will have over here enable compounding popped up. So again, look at the two choices, first month or currently selected month. I want to increase it by, let's say 2%. 2%, but compound it, enable compounding. So I say, okay. So now 100 becomes 102, 104, you see it's compounded. It didn't work very hard. So it's adjust row amount. I type 2% here and enable compounding. I'll do it again. I could do it on, that was the best is interest expense I showed you. Let's see if they have it on interest income as well. No, so maybe interest income is on the bottom. Yep, interest income right here. Okay, so let's say interest income is 200. Of course, we want it to be compounded. So currently selected month. This time I do it by 3%. Enable compounding, and we say, okay. So it's 200, 206, 212. Yes, it's definitely compounding. And then you have 28, 38, 46 in interest expense, in interest income. You could also do it as an increase from last year. Let's say you spend $1,000 once a month on advertising. But because of inflation, increase without compounding, increase it by 200%. See, it became 3,000 is the calculation right now. If I want to copy across, I just copy across, and this is the amount for the year. So if I think my budget of 40,000 in advertising expense is correct, fine. If I decide that I want to change and spend more during the summer month, so I might spend more in June, July, I might say here, I'll increase it to 5,000. It doesn't have to be the same. Maybe June, July, I'll spend 5. Okay, so that's my projection. Let's see depreciation. Okay, I want to point out depreciation because we did it once a year. Okay, so you see 44, 435, 91. They took that number from the previous year. And it was done in December only. The correct way to do depreciation is to spread it out over 12 months. So you could take the 45,000 that I did and divide it by 12 in a calculation field and put it right here, 337.50. Copy across. This will be more accurate because your budget should be monthly, not annually at the end of the year. If I kept the 45,000 in December, your December month for sure will show losses. So I don't want to show losses for 1 month. And that's the reason I'm doing it like this, spread out. Okay, so the dues and subscription means like a newspaper. Let's say we're spending $75. So we copy across and we have $75 across for dues and subscription. Like this, every one of these accounts. Okay, so what we don't see here is payroll yet. That's a big expense. Gross wages, payroll is not done. So let's say we're spending 15,000 every month. Again, it's just an estimate. But my problem is I don't know if it's accurate or not. Let's see the income again. Subcontractor, do they have a big expense for subcontractor? Yeah, 53,000 over here. So we're gonna do subcontractor at maximum 1,000 a month because I'm doing more employees. Okay, the income is fine. So we have 112 plus 36 plus 16. Okay, my problem is that I don't see how much money coming in and how much money coming out. There's no subtotals. So the annual total right here, I'm doing rough estimate of these totals to figure out if I still have income or loss. So this is too high. Let's spend 5,000 across on employees. Okay, so now I'm going to save my work, click save. And this budget is saved, but I'll have to see it. So I'm going to go to reports. Again, you're going to reports and menu and budget and forecast. And this is budget overview because my problem with this screen, I don't see a bottom line. How much is income minus expenses? So I don't see it. So I go to budget overview, show me profit and loss for 2023. I want you to see the whole screen. 1 second. Budget reports for 2023. Then you press next. And account of the month. Okay, that's good. Account by month is fine. If you want to change it to manual, you're going to change it later if you want to see the whole year in one shot. Okay, click finish. And this is your budget. So if your budget doesn't work, you go back and forth. Budget, you can work on a budget couple months. So usually October, they sit down and making a budget for next year. October, November, December, without knowing the October, November numbers really of the current year. So you're estimating the last year. That's how you prepare the budget. You're estimating the last quarter of the year based on the first 3 quarters. Okay, so what I see is that we have a net loss in the beginning, really, in January and February. And bottom line, I have to go all the way to the end. I have a net loss of 30,755.02. Okay, so now I'm looking at the annuals, the beginning and the end, beginning of the year. And then I'll see that my income is really too low. Subcontractor labor income, material income. Okay, so here's my numbers. Let's take the actuals of this year. This fiscal year. And I'll fix it based on that. Okay, so we see labor income is 208. It's a big difference than what I had. Material income is 130 and subcontractor is 82. So he took the wrong year because we didn't finish, so he took 2021. So this is the year that I'm going to fix it. Okay, so my numbers are very low on labor income. That's where my problem is. I hope for 20,000 every month. 240. Material income. Let's do 7,000 every month. That looks better. And this one will bring down also to about 6,000 every month. Okay, looking better. And equipment rent and design income, we can do 900 every month. Okay, again, this is wishful thinking, but I'm increasing from last year. Permit reimbursements, you see that they did sometimes. So maybe I'll add 225 in this one quarterly. And this month, 225. Okay, cost of goods sold is very low here. It doesn't make sense. If materials income is 7,000, so our cost is, yeah, let's do this copy across. Okay, so we're not making so much on materials, but it's fine. Job materials, good. Permits and licenses. 45 is depreciation. Taxes. Okay, so payroll taxes. Let's say 5,000 multiplied by 7.65%. Not a lot in this field, okay. Maybe point. Let's see if we will do it, 15.3. I have too many zeros. Too many periods, 1 second. It's 785 in taxes. Okay, so copy that across. I did double FICA, 15.3. That's what I was doing here. Okay, futile. It's about 7%, 0.8. Okay, let's try. 5,000 multiply by 0.08. Lost afterwards. 400. Okay, so that's going to be SUTA. Multiply by 5.8. So it's 0.58, sorry, 0. $5,000 multiplied 0.58. 290. Okay, so we're going to do copy across just to get some idea of the taxes, and I'm saving it again. Now it looks more realistic. Okay, so I'm ready to look at the reports. Report, budgets and forecast, budget overview. Of course, it's a forecast, it's an estimate, a lot of estimates that I was creating, and it's down here. Now I'm going to have net income on most of the columns because I based it on this current income. And I have a total of 134. I still would fix it and look at the expenses, but it's much better. So what I wanted to point out on how to print it differently. Right now it's showing by monthly. So you could switch by saying customize report. Always it says by month here, display, switch it to totals only. That will be easier to work with as a report. So right now you have one column only, January to December, annual column with a summary for the year. So this is your summary for the year. You have income and expenses and interest income at the end and so on. Okay, so what I want you to practice is the compounding. Okay, so I'll do it again. I'm going to company, planning and budgeting, set up budget. And if you need to increase, let's do it on income. Take it to the top. Okay, so if the book said, take the design income of 900 and increase it compounding by 1%. So you click on adjust raw amount, select currently selected month, increase by 1%. Okay, and enable compounding. You'll see 900, 909, like that, 1% went up. Just to review that part, I'll do adjust the raw amount, selected, and switch. That's the instructions in the book. And you can use the decrease as well, but most of the time with inflation, things go up. Okay, so this is chapter 15. Let's review what else you have in chapter 15. You have sales tax that I showed you on items and services. If you need to create a new item and services of sales tax, you go look for sales tax. Here's the example. City sales tax of East Bay Shore is 0.3. 0.3, and City of East Bay Shore is collecting the tax. If you want to see out of state, it's going to be 0. At 0, State Board of Equalization, it doesn't hurt to put it, but it's 0. And these are all your states. Okay, if I want to create a new one, you see they say sales tax item. So I do item new, sales tax item, New York City tax, state tax, sales tax for New York City. And let's say I'm putting 8.765%, of course. And the tax agency will be New York City Department of Finance. Very easy to create the sales tax. So I'm quickly adding this vendor and I'm done. So now if I have a customer who, if the company is in New York, and when you create an invoice over here, you'll be able to choose New York City and it will be 8.765 of whatever they're buying. So if they're buying, of course, not service, let's say they're selling an interior door, $172, you see times tax, it's $6.31 done for you because you prepared New York City stack. If you did San Domingo, it will be $540 because it's 7.5. If you did City of Bayshore, County, $805. If you did East Bayshore, it's only 22 cents. So all of it is created and it's saved, and then you could choose the correct one based on where the customer and location. And if the customer is not taxable, you're switching here to out of state. Okay, out of state, it could be any person who gave you a resale number. A resale number means that they're selling again. So if they give you a resale number, you are not charging sales tax. If it's like a church, synagogue, all those are out of state and then they don't charge. So that's a tax exempt. So out of state is tax exempt. And on the vendor side, you will say it as well. You go to vendors on top here. When you create a new vendor, let's say an example, Church of Mary. And let's go an example. So we go into tax setting, vendor eligible for 1099, vendor tax ID. You will get the number over here. It's a resale number that you'll have to type. Okay, and the rest is just basic address information and so on. So if this vendor is eligible for 1099, it's going to be here. Let's do it from the customer point of view. And now we're going to customer, and the customer is the church of, or synagogue, doesn't matter which one. You choose new customer. I want to point out where you have opening balance right here. So if you didn't do it in the beginning with me, you're going to do it right here. Opening balance, the name of the customer is John Doe, whatever, John here. And you're going to write that he owes 200. So that will create the opening balance equity as well. So you have to be careful with, where it's being created. If you need information about this person is not going to pay sales tax, you say, the best is to just say tax code is non-taxable. That's the best. And then you put the resale number here. What does it mean, the word resale? That he's buying in big quantities, dozens and so on, and he resells. He has a store and a business, and he buys 10 windows from you, but he sells them. He resells them. So that's the reason there's no tax. So first you're doing non-taxable. Then you, to make sure that it's going to be right, also select out of state and obtain the resale number that I was talking about. So that's how you do it for a customer that is not going to be charged sales tax. Okay, so that's their resale number or tax exempt number you're going to put here. Okay, so last review, I'm going to go back to slides. So on Blackboard, I want you to review chapter 13 that I showed you today. Chapter 14, I don't think there's anything new in 14. Maybe 14 is... Okay, it's the same review. So 14 is not important. You go into 15. Okay, I'm opening 15 and I'll share it. Okay, let's try if I do a slideshow. Okay, here, 15. So 15, what we just did was the beginning of chapter 15, which is budget. I want you to read about Ask My Accountant, audit trail, bad debt, very important topics here. Okay, so budget is the first subject that we did. Select from company, this is review. Select company, planning and budgeting, set up budgets, and select the year. After you're selecting the year, what budget type it is, if it's profit and loss or balance sheet. I didn't show you balance sheet, I showed you only profit and loss. Additional criteria is not needed. Next, and instead of create from scratch, we did from existing numbers. But create from scratch, you will be doing the accounts that you really want. Income and expenses that you really need. And then you click finish. Okay, so that's about budgets. And I showed you how to create the increase of compounded interest and things like that. Now, sometimes a company is bidding for a price. They're bidding for a contract. If it's a government contract, let's say RC Construction wants to build a safety locks, little cabinet for guns. So they want to bid for the government to construct this little closet. And they're giving a bid by doing an estimate on the screen. Remember, estimates are not posted anywhere. It's not going to your account receivable. It's just saving, but not going anywhere. So remember that. Okay, so this is an estimate, bill customer. And then comes bad debt. Direct write-off or allowance method. So please read it. You're going to use, there's 3 ways of doing it. Make general journal entry, use receive payment window, or use credit memo window. So there are 3 ways of doing write-off in QuickBooks. This is when a customer is for sure not paying me. You have like maybe a bankruptcy notice, something like that. That's definite, not just a maybe, but you want to write it off. Okay, audit trail and ask my accountant. So I showed you ask my accountant that I use it many times, and not during a test or not during your projects, you are the accountant here. But ask my accountant is a way that the clients could do a debit whenever they need. Let's say they're writing a check, this will go and ask my accountant, and later the accountant figure out if it's an expense or an asset. But if they didn't use ask my accountant and they wrote supplies, I would never find a computer that they bought and things like that need depreciation and they should have been in an asset. So it's better to use ask my accountant, and you clean it up once a year. Okay, so this is chapter 15. Please read it carefully. And we're done for today.